Hi, thanks for joining us. I'm Grace Cavantis, and I have with me Mike Eklund. And today we're going over our market update of 2022, and we're now in the first quarter of 2023. So to get started, we release one of these each quarter, going over market updates, hot market topics, and we want to make sure you know that these are for informational purposes only, and this does not constitute investment or tax advice. So to get us started, Mike, can you share with us what happened in the markets over the past year?
Yeah, thanks, Grace. Yes, it was a very challenging year for stocks and bonds, and for many of those that kind of followed the markets and their portfolio probably saw that firsthand. But just from a big picture perspective, the global stock market was down a little over 18% last year. This is U.S. and international stocks. U.S. stocks down a little bit more, about 19%, and actually international developed, which is things like Europe and Japan, Australia, was down less. So this is the first time in a while. If I didn't feel that way because it was still down, the international markets actually outperformed the U.S. markets, down about 15%. And then the emerging markets came in line with the U.S. markets as well. So the one thing that was kind of different than this year, what we've seen in the past, is the bond markets have historically kind of come to the rescue of the stock market. When the stock markets perform poorly, a lot of times you see a good year in the bond market. But unfortunately, that, as you see here, that is not the case. The bond market had, as you'll see in the next slide, it's actually worst year on record. U.S. bonds down over 13%, international bonds down about 10%. So it was just a very challenging year. So we understand if you felt the pain, because it was not there was no place to hide really in the markets this last year. And to put it more into context, if you go back to 1926, as I mentioned before, the 13% return for U.S. bonds was the worst in the last almost 100 years. So there has not been another period where it's just as bad. So bonds did really poorly, and stocks down, using the S&P 500 down about 18%. Was also the seventh worst on record. So we're talking about the worst bond market in the last 100 years, the seventh worst stock market in almost 100 years as well. So this was kind of unprecedented territory. Now there is a silver lining. We'll get to the next slide, but just wanted to put in context kind of how that compares to previous periods.
Yeah, sounds pretty bad.
Yes. So the good news is, as we look at this next slide, is that, first of all, this was the 26th time since 1926 the stock market was down in a year in U.S. stocks. So typically the stock market declines about 1 in every 4 years. That's on average. Now it's not guaranteed, but about 1 in every 4 years the stock market is down. Now the silver lining is, historically, now there's no guarantee here, is that the performance of stocks after the market decline has been pretty strong. So on average, U.S. stocks have performed about 13% the year after, and that's an average return. The median return is about 21%. So as painful as 2022 is, as we record this so far on January 24th, 2023, so far we've had a pretty good start to the year that's kind of reflecting what we've seen in the past, which is typically a positive year after a negative year, which we saw last year.
And so that was U.S. stocks?
That is correct. That's U.S. stocks. So actually, so far this year, international stocks have actually done even better than U.S. stocks. So we've seen a strong start to 2023 for U.S. and international stocks so far.
That's exciting.
So hopefully the trend continues, but as we know, there's nothing that's guaranteed in investing.
No, but looking at those returns the years after a down year, it looks like maybe we should be invested in just big companies. What should that look like?
It's hard to have, I don't have a crystal ball as we move forward here. So historically, it's good to own a globally diversified portfolio. That's large companies and small companies. And that's, U.S. companies and international companies. We'll get to a slide in a few here that kind of looks at predictions or forecasts in the future. But that's the one thing that's challenging about investing. We don't think that you should kind of put all your eggs in one basket.
Gotcha. Okay. So then if we zoom out and look at the past few years, it's been pretty rocky. But how has that ended up for investors?
Yeah, and that's the kind of key takeaway, is that the fee you pay for higher stock returns is that volatility, is those ups and downs. So if you would have just invested on January 1st, 2020, you went to sleep, never looked at your portfolio, never looked at anything, and came back 3 years later, and you just invested in, let's just say, the S&P 500 or large US companies, your portfolio would have been up about 25%. So that's not bad for kind of, obviously the COVID drop you see there in March of 2020. We had the increase from there, and then obviously the drop in 2022. You still would have up almost 25%, which is almost a return of about 10% or 9.65% average return per year. So things could have been a lot worse. And that's what I mentioned before, is that fee you pay for those higher returns is that volatility. And as you see here on the slide on the right is, obviously 2020 and 2021 were better years. And we also saw, more times we saw all-time highs in 2020 and 2021. But, like I said, it's the longer you invest in stocks, the safer they are. It's just in the short term, you do see a lot of this volatility. So to that point, the last 20 years have been interesting years in the stock market or in the equity markets. This slide really is trying to show you the value of a diversified portfolio. Won't go in detail in terms of what's the perfect mix of large or small or US or international stocks. But the reality is, for someone who invests in a more diversified portfolio, a mix of stocks and bonds, actually did better than those who just invested in the S&P 500. Now, as the slide shows on the right, there was times that you were really happy you were diversified, like the 2000 to 2002, when you only were down 15% versus the S&P 500 was down 40%. But there's other times, probably during the kind of 2009 to 2019, where you made some money, but nowhere near as much as those that just invest in the S&P 500. But if you get to the bottom of the slide, you notice that the diversified portfolio overall, even though there were times it did not work, was the better outcome than just investing in the S&P 500.
Yeah, and this goes back to 2000?
That is correct, 2000 to the end of 2022.
So 22 years of returns, you're better off diversified.
Yeah, and we always like to, you're diversified if there's a part of your portfolio you don't like. And so that's usually the part that if you think everything is great, that means you're probably not diversified. So it just shows the benefit of diversification. We think highly of that here at Financial Symmetry and implement that with all our clients that, like I mentioned before, it's not good to put all your eggs in one basket. As you move forward, as we get more detail on how, we talk a lot about, the stock market, the US stock market, the international stock market, those stock markets, what's part of that is all the companies that are included. So the Russell 3000 index, which really tries to include all the stocks of the US stock market, not just the top 500, all the stocks. What this slide is showing is that in 2022, the companies that had done better, had really done well the last 10 years, such as Amazon, Apple, Microsoft, Alphabet, Tesla, were actually the worst performers. Those are the ones that really held back performance of the market or the index. And the kind of the companies you didn't hear as much about over the last 10 years, such as ExxonMobil, Merck, Chevron, those actually were the ones that did the best. And so that's the difference between what's called growth and value investing. So growth investing are typically the kind of the flashier names, the ones you hear about. They're also the most expensive companies. And value companies are more they're cheaper, better priced, not as flashy, but usually over the long term have actually outperformed growth companies. And you can see here, for example, a couple of companies like Alphabet and Meta, which is actually Facebook, were once growth companies, but as they've slowed down, they've become value companies. Well, the good thing for Financial Symmetry clients is our portfolios are set up to overweight value companies. So as their price declines, we buy more of their stock. And so you get the same company, but you just get a cheaper price than someone who bought it at a high price.
Mike, I don't know if you've experienced this, but over the past few years, I think some of the stocks that clients have asked about the most have been some of those growth stocks on the left side. So Amazon, Apple, Tesla. Have you experienced that as well?
I have. And then the funny thing is you've probably been better off in 2022 not owning any of those companies. But it's hard for people to put their investing and their emotions aside.
Yeah.
And I like to say great companies don't mean great stocks. And that situation that occurred in, nothing against, Amazon or Apple, Microsoft, all great companies, but doesn't mean that their stock performance is going to be, better than the markets.
That's correct. So Mike, what do we think is ahead for investors?
So since I don't have a crystal ball, but we do have information that, firms that spend a lot of time and resources kind of taking a look at what they expect to happen in the next 10 years. And so this next slide is experts' forecast for stock and bond returns. from actually 6 different experts, folks like BlackRock, JP Morgan, Morningstar, Research Affiliates, Schwab, and Vanguard. And 2 takeaways I take from this slide. One is the returns look a lot better than last year because prices are lower, which means future returns are higher. And that's stocks and bonds. And bond returns are expected to be much better than they were last year at this time.
Thank goodness.
Close to 5%. Last year, we're looking at 1 to 2%. And the second takeaway is every single firm expects the international markets to outperform the US stocks. So that's still another thing, part of diversification. A lot of folks will look, hey, the last 10 years, US stocks did the best, I should invest there. Where investing is so challenging because that's exactly opposite of what you should typically think. You should think that, well, US stocks have done really well, so they're more expensive. Why don't I invest, diversify internationally to international stocks? And the experts, quote unquote experts, feel the same way.
Neat.
And then the final slide before we kind of wrap up here, I just like to remind folks on our Financial Symmetry's 3-step investment process, just to keep it very simple. First is we develop an investment plan that really starts from your financial plan. We want to understand what your goals are, create a financial plan, and then create a portfolio or investment plan to help you, best chance of you reaching those goals. And that includes, if you need the money in the short term, we say 5 to 7 years, we don't want in the stock market. Like things like last year, we want it more conservatively invested. Now, one might say, well, Mike, bonds did poorly. Why we invested in bonds? The reality is a portion of our bond portfolio is in very conservative bonds that were down, let's say 2 to 3% last year, and not the 13% you saw. So there's different types of bonds that we set up for your portfolio with the best chance of success. So for the shorter term needs, we have more conservative investments. Longer terms, we want stocks, and then we implement through low cost mutual funds and ETFs, tilting towards higher expected returns. And then finally, the part that I think a lot of people pass on is monitoring it. So if the market drops like it did in March of 2020 and did as last year, we may be buying stocks because we do what's called opportunistic rebalancing. We also continue to review how much you should have in stocks based on your situation when you need the money. So it's a process. It's not a one-time event, your portfolio.
Yes. Thanks, Mike. If you would like to learn more about anything we've discussed and you're a Financial Symmetry client, please reach out to your advisor. And if you are not one of our clients, the best place to start is our website. We have a lot of great content out there on our website. We have a blog, a podcast, YouTube videos, and just a lot of helpful information for personal finance that you can check out. And if you have any questions for Mike or me, we have our contact information that we'll put up on the screen. So you can email us. We'd love to hear if you have any questions for us that you'd like us to cover going forward, or if you have any feedback on our video. Thank you so much for joining us today, and we'll see you next quarter.
Thanks, everyone.